Hey everyone, hope you're doing well. In today's video, I'm going to talk about the laws that regulate cryptocurrencies like Bitcoin or Ether in Canada. And obviously, part of the reason why I want to do this is that more and more people are seeing the valuable possibilities offered by cryptocurrencies, and there's a growing interest in acquiring them and using them in transactions. But because crypto is a relatively new development, people might not be aware of the rules and obligations that come with getting involved in the world of cryptocurrencies. And so I'm going to take you through some of the key areas of law that apply. I'll put timestamps of the different laws on the screen here and also down in the description in case you want to jump around. So I'm going to start off with the tax rules that you should know about cryptocurrencies, and that's because that's the area that's applicable to most people, especially the newer folks that are treating Bitcoin or Ethereum as investment opportunities. The most important thing you have to know is that cryptocurrencies are recognized as commodities by Canada's tax system and not actually as legal tender. Commodities, for reference, are things like gold and silver, and so crypto would be a digital, intangible version of that. The Currency Act defines the Canadian dollar as the official currency in Canada. So even though cryptocurrencies have the word currency in their name, they don't actually receive the same treatment. For example, your crypto wallet is not insured the way your bank account at a Canadian bank would be. No store or service is forced to accept crypto as payment the way they would be with the Canadian dollar. And your crypto transactions on a blockchain are not reversible if something goes wrong. So the point generally here is that because cryptocurrencies are not an official currency issued by a government or central bank, there's less protections in place and more risk on your end. Alright, so how does crypto being treated as a commodity affect your taxes? Let's assume that you're acquiring a cryptocurrency as an investment. So let's say you buy some Bitcoin with your Canadian dollars. You're not liable for any taxes yet. However, the cost of this transaction will be relevant later. The cost is both the cash you're paying for the actual Bitcoin plus any directly related acquisition expenses like commissions or legal fees. By the way, just as an aside, since we're speaking of investments, at this time, you cannot hold cryptocurrencies like Bitcoin directly in your registered accounts, so you can't hold Bitcoin in your TFSA or RRSPs. But you can invest indirectly through securities that invest in Bitcoin. So for example, the Bitcoin Fund, which trades on the TSX under the symbol QBTC. So if you wanted indirect exposure to the possible upside of Bitcoin in your TFSA or RRSP, you could do it through these sort of funds. Okay, going back to the example where you bought some Bitcoin with Canadian dollars. When you decide to then sell the Bitcoin, meaning here that you turn it back into cash, now you might have some tax liability. If the price of Bitcoin has gone up, such that now you're selling the Bitcoin for higher than the cost you paid for it, and I talked about how to calculate the cost earlier, you must either report this profit on your income taxes as capital gains or business income. This is an important distinction because only 50% of capital gains are taxable, but 100% of business income is taxable. But obviously you don't get to choose which. It's instead a question of fact depending on each person's specific situation. The CRA has said that the following are common signs that your activity is that of a business. You carry on activity for commercial reasons and in a commercially viable way. You undertake activities in a business-like manner, which might include preparing a business plan and acquiring capital assets or inventory. You promote a product or service, or you show that you intend to make a profit, even if you're unlikely to do so in the short term. This is not an exhaustive list, and to determine between capital gains and business income more generally, we can look at the set of factors that the Federal Court of Appeal has used to determine if someone is a day trader, meaning that they're engaged in the business of buying and selling stocks, and that they must report their profits as business income instead of as capital gains. Now, keep in mind that the CRA has said that for tax purposes, cryptocurrencies are not securities like stocks, which is a little bit confusing because, as I'll get into later in the video, cryptocurrencies can be treated as securities under Canadian securities law. But regardless, this is still a useful analysis for distinguishing between capital gains and business income, because the tax court has said that the nature of the asset is not definitive in deciding whether the transactions are business income or capital gains. So what are these factors that you want to look at? First, the frequency of the transactions, meaning how often are you buying and selling the cryptocurrencies. There's no magic number for this, but for example in this Mittal case, the judge says that the taxpayer is more likely to be a day trader with 160 trades scattered throughout the year than someone simply making the occasional isolated transaction. Next, the duration of the holdings, meaning how long are you holding these investments before you sell them. If you're holding them for only short periods of time, you're more likely in the business of trading. If you continue to hold the crypto even when you could have sold and made a quick and large profit, it would likely show that you're not conducting yourself as a trader in the business of seeking to buy and sell to make a profit, and instead that these were capital gains. Next, the intention to acquire the securities for resale at a profit. This one sounds weird because you would think everyone has an intention to try and resell for a profit, unless they have some tax strategy to incur losses. But what it's getting at is whether you originally bought this crypto as a long-term capital investment, or did you buy it to turn it into a quick and substantial profit at the opportune moment? So if you just bought some crypto because you wanted some exposure to crypto as part of your investment holdings, that's different from buying the crypto so that you can sell it as soon as it's reached a certain price or return level, which is what a trader would do. And since this is all about your personal intention, what you say or what documents you could provide would help prove your intention. However, the CRA or a court is not required to take your word for it because they can look at all of your conduct regarding these transactions to see what your intention actually might have been, despite what you said. Next, the nature and quantity of the securities. For the nature, when it comes to stocks, typically buying and selling more speculative and riskier stocks are considered to be evidence of a day trader, whereas safer, blue-chip, dividend-paying stocks are evidence of capital investments. When it comes to cryptocurrencies, this factor is not that helpful because cryptocurrencies are all currently very speculative in nature. But there are some cryptos that reward holders for proof of stake for their blockchain, which can be compared to a dividend payment for stocks, and can show that your gains were capital rather than the income of a day trader. In terms of the quantity, here the CRA would be looking at the size of your investment relative to your portfolio, your income, basically your financial means. And this would include also how you finance this investment. Was it with your own funds or did you borrow money or make investments on margin? If your crypto investments are very large for your portfolio and significant relative to your overall income and net worth, then it's more likely that you're in the business of buying and selling crypto. Same thing if you're borrowing money to make these investments. That's quite serious and planned and more likely a business activity. But if you just have some small amount of your wealth in crypto and you made some gains from selling it, it's more likely capital gains than business income. And lastly, the time spent on the activity. How much of your time is spent studying the market and investigating potential purchases? The more of your time you're spending on crypto transactions and researching them, the more likely that this is a business activity to you. For example, in this Mittal case, the taxpayer was spending 25 hours a week on the market, including research and study time. And the judge notes that this was not an occasional call or listing check, but rather a daily devotion to following and studying the market, which would be considered an adventure in the nature of trade, also known as business income. The CRA can also look at your personal knowledge or experience with the crypto market. The more knowledge and training you have regarding these crypto transactions, it could be construed as evidence that this is a business activity to you, rather than this being, again, just an investment for exposure or diversification of your portfolio, which would be capital gains. So to summarize, the CRA can weigh these different factors in determining whether as a fact your profits were capital gains or whether they were business income. And so you should do the same analysis in determining which category the profits fall for you. I also just want to make it clear that when we say business income, it doesn't have to be like a formal business with a registered name and employees that you're running. It can be much simpler than that. And that's because the Income Tax Act in Canada also includes an adventure in the nature of trade in the definition of a business. As the CRA says, even a single transaction can be considered an adventure in the nature of trade, even if it's your first ever cryptocurrency transaction, and if it's an adventure in the nature of trade, it counts as business income. So then what is an adventure in the nature of trade? Again, there is no single definition, but instead these three factors that the CRA looks at and weighs in order to make that determination. First, were you dealing with the investment the way a trader would? Meaning, was your investing conduct similar to someone who does this as a business, even if you only did one transaction? If so, this points to an adventure in the nature of trade. So with crypto, you have to compare what your activity was to what crypto traders ordinarily do. Second, is what you invested in capable of producing income or for personal enjoyment by itself? If what you invested in is something that is only useful by reselling it, then it's likely an adventure in the nature of trade. Is the crypto that you invested in useful by itself, for example, to earn tokens through staking, or maybe you acquired the crypto in order to do some specific transaction where the crypto was required? But if the only purpose of acquiring it was to subsequently sell it for a profit, then it's presumed to be an adventure in the nature of trade. And the last factor is simply looking at your overall intention with this transaction. Did you buy it to then sell it at the first suitable opportunity? That's something that would suggest an adventure. Or did you buy the crypto just to hold as a passive investment, something that would not point to an adventure? Of course, you could have multiple motivations and your intention can change over time, and this is something that the CRA will evaluate. So you want to take into account these three different factors in determining whether your profit from the sale of crypto, even if it was just one transaction, counts as an adventure in the nature of trade and therefore business income, which is again 100% taxable. Okay, so after all this, you've determined whether your profit is capital gains or business income. If it's capital gains, you'll report it on the Schedule 3 form. If it's business income, you'll report it on the T2125 Statement of Business or Professional Activities. If it is capital gains, when calculating your tax liability, you would have to use the adjusted cost base, which for crypto would be the average cost of each of your cryptocurrencies. So because cryptocurrency prices are constantly fluctuating, all of your Bitcoin purchases likely took place at different prices. And so when you then go and sell the Bitcoin, your adjusted cost base is the average price of all of these Bitcoin purchases that you made. And this is because when you're selling, you don't know exactly which specific price Bitcoin you're selling, because they're all identical. So what we do is take the average of all of the costs that you bought it at. Each cryptocurrency you're reporting a capital gain for will have its own average cost base. So you'll have one for Bitcoin, one for Ethereum, etc. And remember, as I mentioned earlier, the cost base not only includes the average cost of the crypto itself, but also the directly related expenses like commissions or other fees. So your capital gain would be what you received from the sale of the crypto minus your adjusted cost base. And the taxable capital gains would be 50% of that. If you've determined it's business income, 100% of your net income from the crypto profits are taxable. But the calculation of net income allows you to reduce your gross income by not only deducting for direct acquisition costs like you do with capital gains, but also by any reasonable current expenses you incurred to earn income. And this is because your activity is at the minimum an adventure in the nature of trade, and so it counts as business income. Up until now, my examples assume that you earned a profit from the sale of your crypto, hence a capital gain or business income. But there could also be the situation that you sell your crypto at a loss, meaning you sell it at a lower price than you purchased it, and thus you would incur either capital losses or business losses. When it comes to profits, taxpayers generally would prefer it to be reported as capital gains to take advantage of the 50% taxable capital gains rule. But with losses, taxpayers generally would prefer it to be reported as business losses instead of capital losses, and that's because business losses are fully deductible against your other income, but allowable capital losses are only 50% deductible and normally only deductible against capital gains. The reason I bring this up is that depending on whether you have a profit or a loss from the sale of your crypto, you may be motivated to either claim it as a capital gain or a business loss respectively. But the analysis you have to do on your transactions to justify the categorization is still the same whether it's a profit or loss, to determine whether what you did was on account of capital or on account of business. And this is by looking at the different factors I spoke about earlier that distinguish day traders from capital investors and the factors that constitute an adventure in the nature of trade, which would count as a business income or loss. Okay, so that covers when you're buying and selling crypto for Canadian dollars. Of course, if you sell your crypto and receive US dollars, euros, or some other fiat currency, then you're doing the same thing, except you just have to calculate the conversion of the foreign currency you received into Canadian dollars at the time of your sale, based on the conversion rules that the CRA provides. The other major category of transactions of crypto that incurs tax liability is trading one cryptocurrency for another type of cryptocurrency or using your cryptocurrency to buy goods or services. For example, let's say you buy one Ether when it's priced at $500. Then a few months later, it's priced at $1,000, and you exchange that one Ether for an iPhone. You never converted it into Canadian dollars or any other fiat currency, so does that absolve you from tax liability? No, because the CRA treats this transaction as a barter transaction. What that means is that the iPhone seller would report business income of $1,000 for this transaction, and you as the buyer would report a capital gain of $500, $250 of which is taxable. This is because the price of one Ether had appreciated by $500, and you bartered it for an iPhone which counted as a disposition event that gave you a capital gain of $500. And the same barter rules apply if you were to trade your Ether for another type of cryptocurrency, like Litecoin, instead of a good or service. If you bought your one Ether for $500, and then a few months later one Ether is worth $1,000, and you trade zero point 0.5 of your Ether for 10 Litecoin, then you have earned a capital gain of $250 on the disposition of 0.5 of your Ether, and $125 of that is added to your taxable income. You should note, however, that if you're simply transferring your crypto from one of your wallets to another, then that would not count as a disposition for tax purposes, and there's no capital or income involved there. If you sell a good or service that falls under GST or HST law, which is almost everything, then you must still charge and collect that sales tax even if you accept crypto for your payment. And the amount of GST or HST that must be collected needs to be calculated based on the fair market value of the crypto at the time of the sale. The idea here is that you can't avoid your sales tax obligations simply by receiving payment in crypto. So for example, in Ontario, you would still need to take 13% of the price of what you sold in crypto in its Canadian dollar market value at the transaction date and remit that to the government. When you receive payment as crypto, you could end up paying taxes twice. If you recall the example I gave earlier of the purchase of an iPhone for 1 Ether, the business in that situation who received the 1 Ether, which was valued at $1,000 in the market at the time, would report $1,000 as business income. And then when the business disposes of that 1 Ether themselves, they would either report the profit or loss from that disposition as capital gains or loss or business income or loss, depending on what happened to the price of the Ether at the time of their disposition and what they did with the Ether, meaning did they keep it as capital property or did they conduct themselves in an adventure in the nature of trade with it. As you can see from what I've discussed, for a lot of these acquisition or disposition events like trading crypto for other crypto or trading crypto for a good or service, these events result in tax obligations that are entirely dependent on the market value of the cryptocurrencies at the specific time of the transaction. This is why the CRA suggests that you should maintain a detailed record of your crypto transactions, so that it can be verified what crypto was traded, what quantity, when it was traded, what was the market value at the time, etc. This would include keeping track of digital wallets and crypto addresses of yourself and the parties you transact with. One last thing to consider on the topic of taxation for crypto, which probably doesn't apply to a lot of people, but it's still worth mentioning, is that if you have more than $100,000 Canadian worth of cryptocurrency situated, deposited, or held outside of Canada, then you're legally required to report that to the CRA by filling out a T1135 form. This is the same form that you would use to disclose all specified foreign property held outside Canada worth more than $100,000 at any time. And the point is that the specified foreign properties can include cryptocurrencies. Alright, so that covers Canadian taxation when it comes to cryptocurrency. Now I'm going to get into some areas of law regulating crypto in Canada that might affect you based on what you do with your crypto. Let's start with the identification and record keeping requirements imposed on cryptocurrency exchanges. And that might affect you in the sense that it's information about you or your transactions that's being recorded and might be reported to the government. Under changes to the Proceeds of Crime, Money Laundering, and Terrorist Financing Act, all dealers of cryptocurrency to Canadians, whether they're in Canada or elsewhere, are designated as money service businesses and face the following compliance requirements: identifying all clients, appointing a compliance officer, and maintaining records of clients and transactions. They must also report details of any crypto transaction involving $10,000 Canadian or more in value to FINTRAC, which is the federal agency which monitors for money laundering and terrorist financing activities. Any transactions which these exchanges believe are suspicious must also be reported to FINTRAC. So again, these are requirements imposed on money service businesses dealing with cryptocurrency that you may buy from or sell to, and so you should know that the transactions with these entities are not anonymous and are recorded and sometimes reported to the federal government. Next, I'm going to touch on cryptocurrencies relating to divorce and family law and inheritance relating to wills and estates. So when it comes to divorce, cryptocurrencies will come up in the dividing of assets between spouses. Under most provincial family law statutes, cryptocurrencies like Bitcoin would be treated like other investment assets, like stocks. And that means that the crypto you acquired from your date of marriage until your date of separation would have to be divided with your spouse. If you had crypto from before the marriage, that amount would be deducted from the amount to be divided. However, any appreciation in value of the crypto that you held during the marriage, meaning for example increases in the value of your Bitcoin holding because the price of Bitcoin increased during your marriage, would have to be divided with your spouse. So the actual rules are pretty straightforward when it comes to asset division, but the big difficulty when it comes to crypto during a divorce is actually tracing its existence. Since crypto is traded between blockchain addresses and not held in someone's name like a bank account, it's much harder to verify which crypto wallets the spouses actually hold. Under family law, spouses need to provide full disclosure of their finances to each other as part of the divorce process, and this would extend to crypto addresses and wallets. When it comes to inheritance for crypto, like other assets of an estate, a deceased person can pass their crypto to beneficiaries. When a person dies in Canada, they are deemed to dispose of all of their property at fair market value. And since crypto is treated as a commodity by the CRA, if the crypto holdings have increased in value from the time the deceased purchased them, here meaning the fair market value on the date of death, subtracting for the adjusted cost base, then there will be capital gains owing by the deceased on that amount. If you want to designate someone to receive your crypto on your will, you should remember that the anonymous, decentralized nature of crypto holdings makes it very important to include instructions on how to actually obtain a copy of the private key for your crypto. You want to include instructions in the will and not the private key itself, because wills can become public documents following probate, and you never want to publicize your private key at any point. The last topic regarding cryptocurrency law in Canada is how they're regulated, which is important for you to know in cases where the blockchain for a cryptocurrency you're invested in is hacked, or the entity behind this cryptocurrency or the platform holding it for you may be committing fraud. Cryptocurrencies in Canada are regulated under securities law, and the Canadian Securities Administrators has said that businesses marketing their coins or tokens as software, including initial coin offerings, are not necessarily exempt from securities law, because oftentimes these coins or tokens can actually be investment contracts. So what's the significance if a crypto token or coin is classified as a security? It means that the issuer or the crypto platform facilitating its transfer has to register and comply with disclosure and reporting requirements to the Securities Commissions. The Securities Commissions will be the one regulating such cryptocurrencies, and so if you have any legal concerns regarding a crypto that you're invested in, you want to contact the relevant Securities Commission for assistance. So that concludes a breakdown of law in Canada surrounding cryptocurrencies. To reiterate again, because this is such a relatively new phenomenon, the technology is going to continue to evolve, and so will the law. For example, maybe a decade from now, the CRA might not treat crypto as a commodity, but rather as a currency, depending on how it's being used and the government policies about it. So you want to make sure to do your due diligence to be informed about any changes in cryptocurrency laws and how it affects you. As always, this is just legal information, and if you need specific advice, please discuss it with your own lawyer. Thanks for watching, and please make sure to like the video and subscribe for more. Until next time.